Is owning a car, burdened by those loan payments that feel like they stretch out forever, truly the smartest financial move? Or is that lure of lower monthly payments from leasing actually like a hidden trap waiting to spring on you? We're going to dive deep into your sources today and try to figure this out.
Welcome back to the deep dive. Yeah, today we are tackling a really big one. The whole financial wrestling match between leasing and buying a car here in the US. Using the articles and the info you've all shared, we're going to break down exactly what happens with your money in both cases.
That's right. Our mission is, well, it's pretty straightforward. We want to cut through the marketing hype, look at the real numbers, the conditions laid out in your sources, and pull out the key insights that'll genuinely help you figure out which option might fit better with your finances, your lifestyle. No fluff.
Exactly. Just the facts and what they mean for your wallet. So let's maybe start by just unpacking the fundamentals here.
Yeah, the basics. Buying versus leasing.
Absolutely.
Yeah.
At the simplest level, buying and leasing set up two totally different relationships between you and the car you drive.
Right. When you buy a car, it's pretty simple conceptually. You're getting ownership of that vehicle. It becomes, your asset.
And for most people buying a car, that ownership isn't immediate. It usually comes through financing, right? Typically a car loan. So your monthly payments, in that case, are mainly structured to pay down the principal balance, the actual amount you borrowed to buy the car.
Okay, and that's important because with each payment hitting the principal, you're actually building equity, right? You're increasing the slice of the car's value that you own outright.
Precisely. You're swapping debt for an asset on your personal balance sheet little by little.
And how long does this usually take? The sources mention typical loan terms.
Yeah, they typically range from 3 years on the shorter end all the way up to 7 years now. Sometimes even longer, believe it or not.
Wow, 7 years. That's a long commitment for a car payment. We definitely need to circle back to what those longer terms mean for the total cost. But the end game for buying, assuming you make all the payments, is clear. Loan's done, you own the car, period.
And that full ownership gives you a lot of flexibility. It's totally yours. Keep driving it payment-free for years, sell it privately, trade it in. The value, whatever it is yours to use.
Okay, now let's flip the coin. Leasing. That sounds different.
It is fundamentally different. Like your sources say, think of it more like renting the car for a fixed amount of time. And the critical point is, you do not own it. The leasing company or the bank holds the title.
That's the key distinction then, no ownership.
That's the core of it. And because you don't own it, the monthly payments are calculated completely differently from loan payments. Instead of paying off the whole purchase price, your lease payments are mainly covering the car's estimated depreciation during your lease term.
Depreciation, okay, that's the big factor. How much value the car is expected to lose while you're driving it.
Exactly. You're paying for the portion of the car's value that you're essentially using up. Plus, on top of that depreciation, your payment includes something often called a rent charge or a money factor. That's basically the finance fee, like interest, that the leasing company charges for letting you use their asset.
So you're paying for the use and the value drop plus their fee, but not the whole car.
Correct. And this usually happens over a shorter time frame too, right?
Yeah. The sources mentioned lease terms are generally shorter than loans.
That's right. Typically, just 2 to 4 years.
Yeah.
And that shorter term is a big reason why the monthly payments are often lower. You're covering less depreciation over less time.
Okay, so fast forward 2, 3, 4 years, lease is up. What happens then? You've made the payments, driven the car. Now what?
Usually a couple of main options. The most common is you return the vehicle to the dealership. But, and this is important, that's where you might run into extra costs, like end of lease fee. We definitely need to talk about those potential charges.
Okay, return it and maybe pay fees. What's the other path?
The other path, if your lease contract allows it, is a purchase option. You might have the choice to buy the car for a price that was set way back when you signed the lease.
Ah, and that price is the residual value we mentioned earlier, what they guessed it would be worth.
Exactly that. It's the leasing company's prediction of the car's market value when your lease ends. And understanding that number is key to understanding how they calculate your payment in the first place.
Which brings us squarely to the money part, the dollars and cents. This is often where people get, really focused.
It is. It's the headline grabber. That seemingly lower monthly payment you get with leasing.
Yeah, everyone talks about it, lower payments.
And it's usually true. It is the main appeal. For a similar car, the monthly lease payment is often lower than a comparable loan payment.
And now we understand the why behind it. You're only paying for the depreciation during the lease term, plus the rent charge and fees. You're not paying off the full price.
Let's walk through that example calculation from the sources. It really clarifies things. Say you negotiate a car's price down to $20,000. In leasing terms, that's often called the capitalized cost after any down payment or trade-in.
Okay, 20 grand starting point.
Hmm.
And let's say a standard 3-year lease, 36 months.
Perfect. So the leasing company estimates what that $20,000 car will be worth in 36 months. That's the residual value. In the example, they pegged it at $8,000.
So the car is expected to lose $12,000 in value over those 3 years. 20K minus 8K, that's the depreciation amount your payments need to cover.
Precisely. That $12,000 is the core amount. If you just divide that by the 36 months, what does that come out to?
$12,000 divided by 36, that's about $333,000 a month.
Wow, that sounds really low compared to buying a $20,000 car on a loan.
It does, doesn't it? And that's the hook. And this is really critical, that $333 is only the depreciation piece. Your actual monthly payment will be higher. You still have to add the rent charge, the financing cost, plus sales tax on the payment, plus maybe some other fees rolled in. Oh, okay. So the real payment might be, I don't know, closer to $400 or more, depending on those other factors.
Could be, yeah. The $333 is just the starting point. The low payment is real, but it doesn't show the full cost, or, more importantly, that you're not building any ownership. You're just covering its use and value loss for that period.
Right. Now, let's contrast that with buying using a loan. This is where the monthly payment usually looks higher, right?
Almost always, yeah. For a comparable car and a reasonable loan length, buying means higher payments up front. That's the trade-off. But what are those higher payments doing?
They're paying down the principal, building that equity we talked about, getting you closer to owning it.
Exactly. Your money is going toward actually acquiring the asset, even while it depreciates. And when we talk buying with a loan, we absolutely have to talk interest. That's a huge part of the total cost.
And the sources mentioned something about interest being front-loaded. What does that mean exactly?
It's a really important concept. Front-loaded means that in the beginning of your car loan, especially the first year or two, a much larger chunk of your monthly payment goes towards paying the interest that the lender is charging you. Less of it goes towards reducing the actual principal amount you borrowed.
So even if my payment is, say, $500 a month, in the first few months, maybe only $100 or $150 is actually reducing my loan balance. The rest is just interest cost.
That's basically it, yeah. As the loan goes on, that balance shifts and more starts going to principal. But early on, you're paying more for the privilege of borrowing the money. This is why just looking at the monthly payment alone can be so misleading when you compare loans.
Because the total interest paid over the whole loan really tells the story.
Exactly. Let's use those Investopedia examples they provided. They really drive this home. They used a car priced at $48,623, put 10% down, $4,862, so they financed $43,761.
Okay, $43,761 borrowed. Let's first look at how the loan term changes things. We'll keep the interest rate the same for now, say 4%.
Right. So for that amount, a 5-year loan, 60 months at 4% interest, gives you a monthly payment of $805.93.
Okay, $806 a month. And over those 5 years, the total payments add up to $48,355.53.
And the interest hidden inside that total, $4,594.53. Add back the down payment, and the total cost for the car is $53,217.53.
Got it. Now, what if we stretch that loan out, like way out, say 8 years, 96 months, still at 4% interest?
Okay, now watch the monthly payment. It drops significantly, down to $533.41.
Wow, that's like $270 less per month.
That looks way more manageable on paper, especially if the budget is tight.
It absolutely does. It makes a more expensive car seem within reach month to month. But, and this is the crucial part, the source highlights, look at the total you pay over those 8 long years. It adds up to $51,207.83 in payments.
Okay, and the interest portion of that is $7,446.83.
Right, that's nearly $3,000 more in interest compared to the 5-year loan, even though the rate was the same 4%. So your total cost for the exact same car, just by stretching the payments over 8 years, jumps to $56,069.83. So you save $270 a month, but you pay almost $3,000 more overall. It's a huge trade-off. You're paying a big premium just for that lower monthly payment.
Precisely. The longer term dramatically increases the total interest you fork over, making the car significantly more expensive in the end. This is such a critical point from the sources. Don't get seduced only by the low monthly payment on a long loan.
Okay, lesson learned on loan terms. What about the interest rate itself? Let's use that same car, same amount financed, but compare 4% versus, say, 6% interest.
Good comparison. Stick with a 5-year term first. At 4%, the payment was $805.93. Total interest, $4,594.53.
Now bump that rate to 6% on the same 5-year loan.
The monthly payment goes up to $846.30.
Not a massive jump per month, but
But the total interest paid over the 5 years.
it jumps to $7,036.
Whoa. So just a 2% rate increase adds over $2,400 in interest over 5 years. That's substantial.
It really is, and it gets much, much worse on longer terms. What about the 8-year loan at 6%? Okay, the 8-year payment at 6% is $575.08. Still lower than the 5-year payments, but higher than the 8-year at 4%. But the total paid over those 8 years,
Oh boy.
$55,207.88.
And the total interest.
A staggering $11,446.88 interest.
$11,500 in interest on a car that cost under $50K to begin with.
That's almost triple the interest of the 5-year 4% loan. The total cost of the car with the down payment is now over $60,000.
These examples are so powerful because they just lay bare how quickly interest costs add up, especially with higher rates and longer terms combined. It fundamentally changes the financial reality of buying that car.
And the sources gave some context on average rates, right? Like, what are people actually paying?
Yeah, for context, they noted that for people with good credit, think scores of 700 or higher, the average new car loan rate was around 5.25% in early 2024.
Okay, so that 4% example was maybe a bit optimistic for the average good credit buyer recently.
Perhaps, yeah. And on the flip side, historically, folks with bad credit have faced rates, way up there. The source mentioned averages around 15.77% in the past.
15%. The interest cost difference there must be astronomical.
It's massive. It just underscores how critical your credit score is. It can literally mean paying thousands, maybe tens of thousands more in interest for the exact same car compared to someone with excellent credit.
Okay, so summarizing the money side. Leasing often has lower monthly payments because you're paying depreciation and fees, not the full price. Buying usually means higher initial payments, but you build ownership. But the total cost of buying is hugely sensitive to your loan term and interest rate. But money isn't the only factor, right? The sources talked about restrictions and other potential costs.
Absolutely. And this is where your lifestyle and how you actually use the car really come into play. The first big one is mileage.
Ah, the infamous lease mileage cap.
Exactly. Leases come with strict limits on how many miles you can drive per year. The sources confirm these are often set pretty low for a lot of drivers, typically in that 10,000 to 15,000 miles per year range.
And if you go over that limit, what's the penalty?
That's where it can get expensive and really eat into any savings from the lower payment. They charge you per mile over the limit. It varies, but it's usually somewhere between, say, 15 cents and 30 cents a mile.
Okay, let's run those numbers quickly. Say your limit is 12,000 miles a year, but you drive 17,000. That's 5,000 miles over. On a 3-year lease, that's 15,000 extra miles. At 20 cents a mile, that's an extra $3,000 you owe at the end of the lease.
Precisely. It adds up fast. So if you have a long commute, take lots of road trips, just drive a lot, leasing might be a non-starter financially just because of those mileage penalties. With buying, of course.
No mileage limits from the lender. Drive it to the moon and back if you want.
Well, maybe not the moon. But yes, the lender doesn't care how much you drive. However, it's important to remember, while there's no penalty fee for high mileage when you own, driving a ton still has a financial impact. It increases depreciation, meaning the car will be worth less when you eventually sell or trade it in.
So you pay for high mileage either way, just differently. With leasing, it's a direct fee. With buying, it's a lower resale value.
That's a great way to put it. Another area for potential lease costs is wear and tear.
Right, because it's not technically your car.
Exactly. The leasing company owns it, and they expect it back in good condition, matching their residual value estimate. Lease contracts define excessive wear and tear. Small stuff, like tiny door dings or minor scratches, might be okay, considered normal use.
But bigger things, like a noticeable dent, torn upholstery, bald tires.
Yeah, those will almost certainly count as excessive. And you'll be charged to fix them when you turn the car in. This can sometimes be a point of friction, because what you think is normal might not match the inspector's view.
So even if you stay under the miles, if the car is looking a bit rough beyond minor stuff, you could face another bill.
You could, yes. You're responsible for bringing it back to a certain standard. When you buy the car, you're also responsible for its condition, obviously.
But if it's got wear and tear when you sell or trade your owned car,
It just lowers the price you get for it.
Yeah.
A dealer will offer less on trade-in, a private buyer will negotiate down, but you don't get hit with a separate bill or fee from the lender based on condition. You just absorb the lower market value yourself.
Okay, that makes sense. The value hit happens either way, but the process is different. And what about getting out early? This seems like a big one. Life happens, maybe you need a different car sooner than planned.
This is potentially one of the biggest drawbacks of leasing, based on the sources. If you need to end that lease contract before the term is up, say, after just 1 year of a 3-year lease, you generally can't just hand back the keys and walk away.
You're locked in.
Pretty much. Breaking the lease contract usually triggers early termination charges, and these can be very expensive, like potentially owing all the remaining payments plus other fees. The sources stress these penalties can be so high it makes ending the lease early financially crippling for many people.
So you're really signing up for the full term unless you're ready for a potentially huge financial hit.
That's generally the situation, yes. There might be complex options like finding someone to take over your lease, but it's not straightforward. Now compare that to buying with a loan, if your situation changes.
You can just sell the car or trade it in.
Exactly. You sell it, use the money to pay off the remaining loan balance.
What if you owe more than it's worth, that negative equity situation?
Right, that can happen. If you're underwater or have negative equity, you'll need to cover the difference to pay off the loan. Maybe you roll that negative amount into your next car loan, which isn't ideal financially, but it's possible. The key difference is you're not facing the same kind of structured, often massive penalty fees like you would breaking a lease. You're dealing with the market reality of your asset versus your debt.
That flexibility with buying seems like a pretty significant plus, especially if your life isn't super predictable or you just don't like being locked into strict contracts.
It definitely is. It boils down to your tolerance for different kinds of risk. Leasing gives you predictable payments usually, but unpredictable, potentially high back-end costs if you break the rules or need out early. Buying might have higher payments, but the risks are more about market value and interest rates, with more freedom to sell when needed, even if you might face negative equity.
Okay, let's shift back to buying for a second. The sources had some good points on what actually influences the interest rate you get. Since that rate is so critical to the total cost, understanding these factors seems key.
Absolutely crucial. It's not just one thing. Several factors play together. First, there's the big picture, the overall economy. What are interest rates doing generally? If the cost of borrowing money is high everywhere, car loan rates will likely be higher too.
Makes sense. Then there are things specific to me, the borrower, like my credit score.
Paramount. Probably the single biggest factor you can influence. A higher score generally thinks 700 plus for the best rates, signals to lenders that you're low risk, likely to pay them back. That gets you lower interest rates. A lower score means higher risk for them, so they charge you a higher rate to compensate.
So taking time to improve your credit score before you even think about applying for a car loan could literally save you thousands over the life of the loan.
Easily. Thousands. It's probably the most impactful thing you can do. Another factor is your down payment. Putting more money down up front means you borrow less, which reduces the lender's risk. It might not always directly lower your rate, but it can help you qualify for better terms overall, and it definitely reduces the total interest paid because you're financing less.
We saw how the loan term blows up the total interest paid, but can the term itself affect the actual interest rate offered?
Sometimes, yes. Lenders might charge slightly higher rates for those really long-term loans, like 7 or 8 years. They see it as taking on risk for a longer period, so you might get hit with both a slightly higher rate and the massive compounding effect over more years.
And where you get the loan from matters too, not just the dealership.
Oh, definitely. You absolutely should shop around. Banks are common, sure, but check out credit unions. Because they're nonprofits owned by members, they often offer lower rates. And don't forget about the car manufacturers themselves. Sometimes they run special financing deals, even 0% occasionally, on specific models they want to sell. Just read all the fine print on those offers.
Good tip. And what about new versus used cars? Does that affect the loan rate?
Typically, yes. Loans for used cars usually have slightly higher interest rates than loans for new cars. Lenders view used cars as having a bit more uncertainty in their value and condition. So that's another piece of the puzzle if you're deciding between new and used.
Okay, so getting the best loan isn't just about accepting the first offer. There's homework to do beforehand. The sources had some practical tips for saving on interest when buying, right?
They did, yeah. A sort of checklist. Number 1, shop for the loan before you shop for the car. Get pre-approved from your bank, a credit union, maybe an online lender.
Why is getting pre-approved so important? What does that do for me?
It gives you leverage. It gives you a real number. When you walk into the dealership knowing my credit union approved me for X amount at Y%, you have a benchmark. You can compare the dealership's financing offer directly. If theirs is better, great. If not, you can use your pre-approval. It stops you from feeling pressured into taking whatever financing they offer on the spot without knowing if it's competitive.
Knowledge is power. Get your financing sorted before you even start negotiating the car price. Smart. What else?
Well, timing could matter, though it's hard to predict. If interest rates are trending down overall, waiting a bit might get you a better rate. More practically, choose the shortest loan term you can comfortably afford. We saw the math. A higher monthly payment on a shorter term saves a ton of interest overall compared to stretching it out.
Right. Pay more per month for fewer months equals way less total cost. Painful monthly, but smart long term.
Definitely. Also, think about refinancing later. If rates drop significantly after you buy, or if your credit score improves a lot, you might be able to refinance your existing loan to get a lower rate, which could lower your payment or shorten the remaining term.
And back to the credit score again, working on that before you even start the process seems foundational.
It really is the bedrock. Pay your bills on time, every time. Try to reduce other debts, especially high-interest credit card debt. Dispute any errors on your credit report. Even boosting your score by 20 or 30 points can make a real difference in the rate you're offered.
And the simplest way to pay less interest, just borrow less money.
Exactly. Be realistic about what car you can truly afford. Choosing a less expensive car means a smaller loan principal. Less principal means less total interest paid no matter the rate. It's basic, but incredibly effective.
There was also that really interesting point from one of the sources, I think it was a Reddit comment, about financing even if you have the cash, comparing financing versus investing the cash.
Right, this adds another layer, the idea of opportunity cost. Whether it's better to finance or pay cash isn't just about avoiding interest. It depends on the loan rate you can get versus what return you could safely own by investing that cash instead.
So it's like, what's my money doing for me? Is it saving me 4% interest by paying off the car, or could it be earning me 5% somewhere else?
Precisely. If your car loan rate is, say, 3%, but you can reliably earn 5% after taxes in a very safe investment, like a CD or high-yield savings account, then financially you might be better off taking the loan and letting your cash earn that higher 5% return. The investment earnings would more than cover the loan interest.
Okay, so low interest rates make financing potentially more attractive from this perspective.
Exactly. The source mentioned this was easier when car loan rates were super low, like in the 2–4% range.
Yeah.
It was often possible to find safe investments that beat that rate.
But what about now, or when rates are higher, like the 8–9% mentioned in that comment?
Then the calculation often flips. If your car loan costs you 8% or 9%, finding a safe investment that guarantees a return higher than that is really, really difficult, maybe impossible. If you can only safely earn, say, 4% or 5% on your cash, but the loan costs you 9%, you're effectively losing money by financing and investing. Your borrowing cost is higher than your investment gain.
So in a higher rate environment, if you have the cash available, and this is a big if, making sure you still have emergency savings and all that paying cash for the car likely becomes the more financially sound move compared to financing and trying to invest.
Generally speaking, yes, from a pure numbers perspective in that scenario. It highlights that the decision isn't static. It depends heavily on the current interest rate climate and your personal investment opportunities and risk tolerance. It's a more advanced consideration, but definitely part of a true deep dive.
It really makes you think about the car purchase, not just in isolation, but as part of your whole financial picture.
Exactly. It's not just about the metal, it's about how the money flows.
Okay, wow. We've covered a lot. The basic mechanics, the detailed costs, especially loan interest, the restrictions like mileage and wear, factors influencing loans, even this cash versus financing nuance. So let's try to synthesize this. Based on everything in the sources, who is leasing really better for and who should probably be looking to buy?
Well, the absolute clearest takeaway is there's no single right answer for everyone. It's not like one is always good and the other is always bad. It really depends on your specific situation, how you drive, your budget priorities, how long you keep cars, how you treat them.
Okay, so let's break down those situations. Who's the ideal candidate for leasing?
Leasing probably makes the most sense if your absolute top priority is the lowest possible monthly payment. Maybe because your budget is tight right now. It's also good for someone who genuinely loves having a brand new car every 2 or 3 years, with all the latest tech and warranty coverage, and really dislikes the process of selling or trading in an older car.
So paying for the convenience and newness without aiming for long-term ownership.
That's a good summary. You're paying for predictable short-term use of a new vehicle. This works best if you're a low-mileage driver, consistently staying well under those 10, 12, 15,000 mile limits. And crucially, you need to be someone who keeps their car in really good shape to avoid those potentially hefty wear and tear charges at lease end. If all those things line up, low payment need, love new cars, low miles, keep cars pristine, then leasing could fit.
Got it. Predictable car, predictable low payment, if you follow the rules strictly. Now, who does buying generally make more financial sense for?
Buying tends to be the better financial bet if you drive a lot consistently, putting on more miles than a typical lease allows. Also, if you plan to keep your vehicle for a long time, say 5, 7, 10 years or more, well past a typical lease term, that's where buying really starts to pay off financially.
Because eventually the loan is paid off and you have years of driving with no car payment.
Exactly. That period of payment-free ownership drastically lowers your average annual cost over the entire time you have the car. Buying also makes sense if you value the freedom and flexibility to sell or trade the car whenever you want, without worrying about lease contracts and those big early termination penalties.
And maybe if you're a bit harder on your cars, kids, pets, hauling stuff.
That too. While excessive wear still hurts resale value when you own, you're not facing specific penalty fees from a leasing company. You decide when and how to fix things without having to meet someone else's standard of acceptable condition.
So buying is generally better for higher mileage drivers, long-term keepers aiming for payment-free years, people who value ownership equity, and those wanting flexibility without lease penalties or strict condition rules.
That captures it well. It's a longer-term investment in an asset, understanding that asset depreciates, but the financial payoff comes over that longer ownership period, especially after the loan's gone.
Okay, so when you boil it all down, it sounds like the choice is between the immediate appeal of lower monthly payments and always having a new car, which is leasing's promise, versus the long-term benefits of building equity, eventual ownership with no payments, and freedom from restrictions, which is what buying offers.
And importantly, remembering that the total financial picture involves way more than just that monthly payment comparison. You have to factor in total interest on loans, rent charges on leases, potential fees for mileage or wear, the cost of ending early, and what actual value, if any, you have left at the end.
The core lesson from all these sources seems really clear now.
Yeah, I think so too. It's absolutely vital to understand precisely what your money is buying in each scenario. Do the math for your situation. For buying, calculate the total cost, including all the interest over the full loan term. Shop for rates before you shop for the car.
And for leasing, look past the low monthly payment. Figure out the total out-of-pocket over the whole lease. Understand the mileage limits and penalties, know the wear and tear rules, and be really honest with yourself that at the end, you walk away with zero equity after spending all that money.
Don't let that monthly payment number hypnotize you. Think about how long you really keep cars, how much you really drive, and how you really treat them. Get real loan quotes. Get detailed lease quotes showing the residual value, money factor, and fees. Compare the full financial story side by side.
It feels like the real deep dive here is projecting these costs not just for the next few years of the loan or lease, but over the whole time frame you expect to need a car.
Which brings us to maybe a final thought, something provocative for you to chew on as you think about this. If you're someone drawn to leasing because you just love having a new car every few years,
Yeah.
have you ever actually added up the total cost of doing that back-to-back? Say 3 leases in a row over 9 years?
Compared to maybe buying one car, paying it off in 5 or 6 years, and then driving it payment-free for the next 3 or 4 years.
Exactly. How does that cumulative cost of constantly leasing compare? Are you paying a really significant, maybe even unacknowledged premium just for that perpetual new car smell? It's definitely something worth mulling over as you make your next move.